Hello, I'm Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. This is another of our regular monthly videos. But I should warn at the start that it isn't about the current monetary situation, and it's not a discussion of recent global money trends or anything of that sort. It's much more about an enduring issue which causes passionate debate between a rather small number of people, but is of much wider importance. And this is the question of how the monetary arrangements that a society has should relate to the central bank, the banking system, the provision of money and banking services, and so on. It's about, if you wish, money and the state, the monetary regime and the state. This topic is basic to social philosophy, to economic organization, and it isn't a settled topic. It isn't something where people have reached definite conclusions. In fact, as I'm going to show, two of the leading free market thinkers of the 20th century disagreed profoundly in this area of public policy. They agreed, however, that big change was needed. I'm going to argue, on the contrary, that big change is not needed. I'm going to defend the current status quo in the arrangements between the central bank and commercial banks on the one side and the government on the other. And in that sense, we have a very satisfactory monetary order. Now, it's going to be a longer than usual video. Anyway, let me begin. What I'm going to do at the start is to discuss the views on this subject from Friedrich Hayek and Milton Friedman. As I said, two of the leading free market thinkers of the 20th century. As we're going to see, Hayek was in favor of money being issued entirely by the private sector, whereas Friedman was in favor of it being 100% backed by the state, so that the government, or perhaps its agent, the central bank, had total control over monetary policy. Totally opposite views by these two great, famous thinkers. Let me just start with Hayek. I should just say that both of these people had their views varied over time, but as far as Hayek was concerned, his most noted proposal in this area came late in his career. It was originally in a pamphlet put out in 1976 and then tidied up and improved in a 1978 version called The Denationalisation of Money. It was published by the London-based think tank Institute of Economic Affairs, 1978. And this little piece of text is by Arthur Selden, who at the time was the IEA's editorial director. Of course, traditionally, monetary policy had been seen as part of the state's role, but in effect, says Selden, Professor Hayek is arguing that money is no different from other commodities, and that it would be better supplied by competition between private issuers than by a monopoly of government. Hayek argues, as Selden noted, in the classic tradition of Adam Smith, but with reference to the 20th century, money is no exception to the rule that self-interest would be a better motive than benevolence in producing good results. So this 1978 pamphlet from Friedrich Hayek advocating competition between different suppliers of money from the private sector. In principle, such competition fighting to find a money of stable value. Now, it's often said that what Hayek did here was to anticipate the emergence of cryptocurrencies in the 21st century. Cryptocurrencies could be viewed, I'm very suspicious of cryptocurrencies, but it could be viewed as competing private sector monies. And I've got a quote here from a paper written last year by Meyer and Bofinger. It says there have been private issued banknotes in the past, of course, but these all of one standard. And what Hayek wanted was something very different from that. He propagated a competition of currencies, competition of different kinds of money, clearly distinguishable by different denominations among which the public could choose freely, choosing between Bitcoin, Ethereum, all that kind of stuff. And then, in the words of Meyer and Bofinger, for decades, Hayek's proposal received little academic, political, or economic attention, but with the creation of the entire cryptocurrency universe in 2010s, currency competition has become a reality. That's their view. Okay, so that's Hayek. What about Friedman? Now, I should just say here that Friedman was not consistent in what he said on this topic. He wrote lots and lots of papers in a very long career, and he varied in his views. However, he was fairly consistent in being supportive of or kind towards the idea that money should be backed 100% by the very safe asset of notes issued by the government, or notes coming from the central bank but supported by legislation coming from the government. So that this 100% cash reserve idea was something included in his 1959 Miller Lectures in New York, although that was only one of a number of occasions on which he made statements about this topic. Now, because cash, I mean notes and coin as well, in fact coin is a very small part of it nowadays, notes come from the government ultimately. The may be issued by a central bank, but the central bank depends on government support. Then, in effect, he wanted all money to be backed by the state, by the government, utterly different from Hayek's position. I should just say here that Friedman was not the first person to put forward this idea. There had been a book in 1935 from another great economist, Irving Fisher, proposing what he called 100% money. And one of Friedman's teachers, a chap called Henry Simons, had said something similar, made similar suggestions in a 1934 program for laissez-faire, which appeared in a 1948 book, Economic Policy for a Free Society. Simons, Friedman thought that what they were proposing was part of a free economy and a free market system. I don't agree with that, but we'll come on to that later. You might wonder what Keynes thought about all this. The answer is that he was very suspicious. And Irving Fisher did he recommended to Keynes that Keynes take an interest, and Keynes more or less ignored the topic, thinking it was impractical. Okay, so that's what I've done, is to set up there's this very important debate between these two very prominent, famous thinkers. And you can see that very radical. Maybe no consensus in this area of economics, but the ideas from both Hayek and Friedman, and then a number of related thinkers, are in favor of a radical change. Let me just make clear that the kind of things that Fisher, Simons, and so on were saying in the 1930s were prompted by the crisis of the 1930s. when there'd been a collapse in the quantity of money, partly because the banking system malfunctioned. The banks had losses, they cut their loan books, that caused the quantity of money to fall, that then caused a further drop in asset prices, further implosion of the banking system, etc. And so they wanted to end this link between money creation by the private sector and these large fluctuations in credit and money that then resulted in the Great Depression in the USA. Hayek in mid-1970s was worried about rapid inflation. So anyway, they're both very radical. Now, I'm going to, so these thinkers regarded themselves as classical liberals. They weren't conservatives. In fact, Hayek once said very specifically that he was not a conservative. So the current status quo in this topic has no defenders, really. I'm going to say that's wrong. I'm going to defend the status quo, and implicitly I'm going to reject the positions of both Hayek and Friedman. Let me then now just describe that status quo and some of this may be for debate and discussion, but we have, it's a fiat money world, no longer with money related to a commodity. There is a government and a central bank, which is the banker to the government. And the central bank has four characteristics. It has the monopoly right to issue legal tender money. Such money has no intrinsic value. If it weren't legal tender, wouldn't be worth anything, and has virtually zero production cost. The central bank is required by the state to keep the real value of that money fairly stable, even though it lacks intrinsic value. The central bank provides banking services not to only the government and the banking system. It doesn't have customers, the rest of the economy, non-bank, private individuals and companies, in the private sector. That is true despite all the current talk about a central bank digital currency. And this central bank is, of course, separate from a competitive, profit-oriented commercial banking system, which has only non-bank customers. It's also quite important to notice that this commercial banking system, I don't say it here, but is actually all countries fractionally reserved, I'll talk about that shortly, and highly leveraged. The fractional reserving is cash isn't 100% of assets. Cash, in fact, is a very low ratio of assets. The cash reserves are tiny. They're just a fraction of the whole balance sheet. And this is possible largely because the banking system can go to the central bank when it's short of cash, and so the central bank has a responsibility to lend cash to the commercial banking system when it's short of cash, debate and discuss, or alternatively the central bank will buy securities from the banking system again to replenish cash. The central bank has a lender of last resort role. The central bank doesn't have a profit objective because it's got to provide this stable currency, that's its job. It's only the commercial banking system owned by the private sector which seeks profits. Now, those characteristics of the present monetary order are, in my view, all positive and benign for economic efficiency. I'm going to explain how they emerged and defend them. Let me just clarify before I go on that I'm thinking about a society which is the kind favoured by classical liberals. Both Hayek and Friedman would see themselves in those terms. This means that there is a government, and neither Hayek nor Friedman were anarchists. I was an anarchist. I'm not an anarchist either. This means that we're not talking about a society without a government. We're talking about a society with a government, and then a government which has expenditure, has to collect tax revenue to pay for the expenditure. At any rate, therefore, has financial transactions to conduct, needs a banker, and sometimes the banker will give advice on how to look after the government's debts. And that is what we have. We have a society with a government. This is not about some sort of state of nature anarchical situation. Because I say that because sometimes people in this subject like to think as if it was anarchy starting from scratch, but it's not the world we're living in. What's wrong with Hayek? Look, competition isn't always the right way to organize things. Societies have one government. The government monopolizes the means of coercion. In theory, it is the only structure, the only institution which can use violence to pursue the ends of justice, maintain law and order, and so on. The rest of the citizens are not supposed ever to use violence to achieve their ends. Well, if you have several governments in one nation, it means you have several governments all with the means to, you're talking about, indeed, anarchy. Talking about, say, Haiti today, where there's gangs in the streets and competing gangs, all right? Or China in the interwar period, warlords in different regions competing, yes, competing, but competing here is not a good idea. Or, competing armies in Sudan. No, we don't want that. We want one government, please, to enforce the law, to maintain the law. Competition isn't the right way to organize things, Professor Hayek, sorry. And then or even think about, say, competition in parenthood. So children are brought up by competing parents, not their natural parents. What nonsense. Coming more specifically on the economic area, there's quite a big literature about when it makes sense to use the price mechanism and when it does not make sense to use the price mechanism. You know, in a company, there isn't subcontracting between one department and another department. Not normally, one person says he gives an order and he wants it done. It's giving an order. It's a fiat mechanism, is what it's called by Ronald Coase, a Nobel Prize winner, who explained how companies, sometimes vertically integrated companies, come into existence instead of the use of the price mechanism in a market context. I'd also mention here Neil Ferguson's 2017 book, where he says that sometimes you want networks, horizontal structures where lots of different suppliers, individuals using a price mechanism perhaps work together. And hierarchies where, again, the fiat mechanism is used. So I'm sorry, Professor Hayek, it just isn't true that competition is always the right answer. And in fact, in the monetary sphere, it's really a downright silly answer. Because when we live in a nation and we're buying and selling things, we want one money. Look, when I go to a shop, 1 week, there are prices in pounds sterling. I go there a week later, I again want the prices in pounds sterling. That's what I'm accustomed to. If there's a number, if the currency changes between the 2 weeks, that's just a nuisance for me. I have to check the exchange rate and so on. Do you think shops want to have lots of different currencies at the same time? Bonkers. Imagine, say, Marks and Spencer's has just to use Bitcoin, Ethereum, half a dozen of the others, there's cryptocurrencies. They receive these on the same day, over the counter if you wish. How do they add up the numbers at the end of the day? What nonsense. No, this is just a balmy idea. And beyond that, this whole area of banking and money, potentially riddled with fraud. I'm not going to talk further about cryptocurrencies, but there's certainly been lots of fraud there. And the question of how the difference between the stated value, nominal value of money, and the production cost, who gets that benefit? Is it to be the fraudsters, perhaps, who've gone and issued money, or is it perhaps to be the government with understood social, political objectives? I'm not going to spend that much more time on Hayek because I don't regard what he's offered here as of any great interest, and it staggers me that there can be any serious consideration given to it. Cryptocurrency is another subject to be discussed at a different occasion. Now, what about Friedman? As I say, he's not by himself. He's representative of quite a big school of thought, and he blessed this idea, but it had actually been put forward by other people. I'm going to argue that the kind of banking system we have has emerged for good reason, and that this 100% cash reserve idea is just wrong. But to get there, I need to go through quite the discussion. All right, so it's very stylized, what I'm about to say. It's a stylized account of how money and banking evolve. It is very controversial, but so we start off as a goldsmith, a lump of gold, if you wish, which is going to work into gold objects. The gold's valuable, so he invests. I'm sorry, I say he, but he or she, he invests in some locks, some strong boxes, in order to make sure that his gold can't be stolen. So he's very good as a custodian of gold because he's got all of this infrastructure to protect, to stop the theft of the gold. And other people come to him to use this infrastructure. As he starts off, he sets up a company. The company's got assets and liabilities. And the liabilities are his equity stake in the business, which he's built up, and the assets are 100% gold, 100% cash. Now, other people want to use these custodial services, the safety of his business, of the infrastructure, of looking after the gold. So they leave gold with this goldsmith. And the goldsmith gives them receipts, gives them notes indeed. So this is the balance sheet. The assets are still 100% gold, 100% cash, but the liabilities are now the goldsmith's own equity capital invested at the start, plus all these notes is issued to the depositors of gold. Now, two things happen. The first thing is that the goldsmith realizes that he's a goldsmith, starting to become a banker, but goldsmith realizes that customers don't all come back at the same time wanting their gold. So what he can do, and the gold's lying there, sterile, not doing, what he does, he lends out some of it. And he earns interest on those loans. The loans must be repaid in gold, the loans are made in gold. All right? Because interest is being earned on that gold, it's possible that he won't have to charge custodial fees to the depositors. Moreover, this is giving a stimulus to credit. Good. In one sense, this is no longer 100% cash reserve banking because the assets include loans rather than gold, even though those loans are repayable in gold. Now, the second development is that the depositors for the gold receive these notes. These notes can be handed back in due course for gold, so they can be used in payments. And it's much more convenient, probably to use notes rather than the physical gold, because the physical gold, there's all these problems about security, theft, all the rest of it. It's heavy to move, and it also has to be weighed and so on, which is a nuisance. So there's in business around where this goldsmith is operating, say London in the late 17th century, the notes are being used for payments rather than the gold. So we have this development on the liability side of the balance sheet. The notes aren't just immobile in the original depositor's hands. They're moving around between the depositor and other people. They're becoming a means of payment. Here we come to the eureka moment. This is where banking really gets started. The notes are being used in payment. Some of you regard them as good as gold. So, why doesn't the banker make the loans in notes, not in gold? That's the big change. Now, this is proper banking. Because this isn't about, well, there still must be some gold, some cash to back the notes, the depositors, and so on, that are in circulation. But it's no longer matched, the liability is no longer matched 100% by gold, by cash. And despite that, the notes are accepted in payment. By the way, when these things were happening back in the, in say, the case of Italy in the 14th, 15th centuries, London, the late 17th century, the Netherlands, the Low Provinces, as they were called in the 17th century too. When these things were happening, the depositors knew perfectly well that loans were going to be made and that they wouldn't be 100% backing of gold. They knew that. All right. We get a situation where the banker is making a profit from issuing notes on which no interest is paid, and making loans with these notes on which he or she receives some interest. And of course, what's the banker's objective? He wants to maximize the return on capital. He has that original capital invested. He wants to maximize the return. I'm afraid, to lapse into some algebra, but I'm not going to spend too long on that in this current video. It's quite important in the presentation I eventually plan to make about this subject. The presentation, by the way, in Buckingham at the Vincent Centre on the 4th of September. You can see that the assets of the bank can be seen as the ratio of the cash held plus the loans, and the cash is the proportion of cash to total assets, C. No profits earned on cash, no interest paid on gold. The profits are going to be earned on the loans, and they depend upon partly the size of the loan book and partly on the spread, which I call S here, charged on the loans. So, if the the spread is, say, 5%, then it's 5 units per year to be paid on 100 units of loan. And what I arrive at here is a formula to explain the determination of the spread, and to simplify, if the loan margin is given, if it is, say, just 5%, whatever happens, then the rate of return on the banker's capital varies inversely with the ratio of cash to assets and the ratio of capital to assets. So what the banker is doing is no longer a goldsmith. What the banker is doing is trying to get those ratios of cash down to push up his profits, get the ratio of capital, the balance sheet down, again, to push up the rate of return on the capital. And as a classic statement by an American banker and economist, a chap called Phillips, said in a 1921 book, "The essence of banking consists in the practice of extending loans far in excess of either the capital or the cash holding of the bank in question. That's what bankers are about. It's not about 100% cash reserve safety. It's taking risks, assessing risks in order to, as far as the bank is concerned, to produce a profit, a rate of return. But in the process, it helps the wider economy because not the customers, the non-bank customers, have got a good means of payment, much more efficient than using gold. And there's also these loans made to exploit credit opportunities. Let's just talk about this spread, the cost of the loans. Let's try and put it into this sort of framework. Suppose we're the bankers seeking a rate of return on capital of 14%. It's a pretty high rate of return, probably won't make it, but things will go wrong. But if the cash ratio is 80%, just starting out, and if the capital, we're still talking about these early days where the goldsmiths' liabilities are still dominated by his own capital, the capital to assets ratio is 45%, then the required spread to generate that 14% return on capital is over 30%. In other words, if the going interest rate is 5%, the banker must charge over 35% per annum. Assuming no inflation, that's a fantastic rate of interest. Where do you see this kind of thing? That sort of thing does happen. Middlemen, car dealers and the like, can sometimes make extremely high returns by buying and selling assets in a short period of time. And that sort of thing goes on in countries like Somalia or Ethiopia, and is the sort of rate of interest often charged by money lenders in societies of this sort. Conversely, let's think about other example here. We're seeking a 14% return on capital. Cash ratio is 1%. By the way, in British banking, in, say, 2004, the cash ratio was under 1%. Under 1%, and the capital to asset ratio is 3%. Capital asset ratios have been as low as that, particularly, by the way, in international banking, in the euro currency markets in the 1980s. And with those figures, you can make a 14% return on capital with a spread over cost of funds of 0.4% of 40 basis points. So you've got here these extreme situations where when the spread comes down, you get a possibility of huge expansion of credit opportunities, much lower cost of finance to the non-bank customers, more capital investment, more efficient production, higher living standards. Going from Somalia, Ethiopia, to London at the high point of the city's prosperity in the late 20th century. So that's the how the move away from 100% cash reserve banking benefits society. Going back to 100% cash reserve banking reverses all that progress. All right. And now I want just that finishes that section. Let's just move on now to talking about two parallel processes that now are underway. One is that, as I've said, the banks are reducing their cash ratios in order to lend more and to earn a profit for themselves, but also they benefit society when they do that. Obviously, they're vulnerable to runs. If their cash ratio has gone down to 20%, and a third of their depositors come back and say they want some cash, they want some gold, then the bank hasn't got it. He has to either sell some assets, pull some loans in, or borrow some gold from elsewhere. Now, in order to meet anticipate this kind of crisis, the banker typically will organize a line of credit from, excuse me, from a safe bank. Often these banks would be in the metropolis, in the capital city. In the British case, country bankers would have a banker in London. When the country banker faced a run, go to the London banker and say, can I borrow from you? I've got a problem at the moment. Of course, there was then an issue for the London banker, because the London banker might be running out of gold too. So the London banker would want a reserve bank as well. And what would that reserve bank be? Remember that we're talking about societies, nations with a government. The country bank, the run-of-the-mill commercial banks, they want a credit line from a safe bank, probably in the capital city, which in turn wants a credit line with the safest possible bank, which is the banker to the government. Always, obviously. So the banker to the government, the central bank, is the ultimate reserve bank. The central banks are often called the reserve bank. And that's the nature of what's going on here. We can see that although society may benefit, ultimately, it's all about specialization within the banking system. Different bits of the banking system have got different functions, but they work together and coordinate and cooperate. Now, the other process going on is that the reliance on a commodity backing to money diminishes over time. As I said earlier on, the use of gold or any commodity, any metal in payments is awkward. There's problems of theft and security. There's problems of weighing the commodity, and there's problems of keeping the commodity in a safe place, all this kind of stuff. Using notes is much simpler, but they too got issues about safety and security. Excuse me. So we've got then there's deposit money, scriptural money, which actually avoids much of these difficulties. One of the beauties, by the way, of scriptural money is it's totally divisible. For cutting up different pieces of gold and weighing gold coins is very awkward. I would also just say that there's a couple of other points to make here. One is that the resource cost of producing notes, registering deposits, is negligible, whereas having to get gold or silver or copper, whatever you want to have, get it out of the ground takes up resources. And the issue of paper is also under human control. Whether that's a good thing or a bad is to be debated. But it staggers me, given all the advantages that moving from commodity-backed money to fiat money generates, given all these advantages, that we still, in the 21st century, hear from advocates of the gold standard. Surely what we have with a low-cost nil resource cost fiat money is much better. I don't deny that there are many problems of managing that, by the way. So what I've gone and done is to explain how the final step in this move away from commodity to paper money is of course to give legal tender status to the liabilities issued by the central bank. This facilitates, by the way, lending to the banking system in crises, because the loans are made just by a stroke of a pen. They don't require any, as a gold would, they don't require new resources, new mines to produce the gold. So we get to the various features of the present system, as I discussed earlier. What I've done here in these two slides is to, on the left-hand side, to describe those features, then in the blue box on the right-hand side to set out the reasons why they exist, to provide a rationale for the system that we find in the real world, in the modern real world. I think this is a good system. I think it deserves to be defended. I'm not in favour of radical change. Now, let's then come back to our friend Milton Friedman. I've just explained why 100% cash reserve banking would be very inefficient compared with the present arrangements, the loss of all those benefits that come from the fractional reserving, the lending out of cash, and eventually the lending out being done in the form of new notes and newly created notes not backed by the cash. I've explained the reasons for all that, reduce the cost of finance, scope for overdrafts. Milton, I'm sorry, you're just wrong about all this. As indeed are your Chicago School colleagues. And let me just say here, perhaps a bit more offensively, a bit more rudely, that look, bankers, we're talking about a free society where we believe in freedom, freedom in business, freedom in banking, freedom in finance. That means people can choose. They can choose, as far as banks are concerned, cash ratios, capital ratios. I know there are problems here, and I know the central banks regulate these issues. All the same, it's better that there is some discretion, some competition, in a sense, between banks in these areas of public policy. Both that's obviously a matter of market situation, but they're a wider public and social interest. So, as far as I'm concerned, 100% cash reserve banking would be appallingly illiberal, an appalling imposition of intervention in a crucial part of the modern free market economy. I think that gives you the guts of the argument I wanted to make today. There's an awful lot more to say. These topics are very, very controversial. There's more to say, much more to say. For example, Walter Bagehot said there should be competition between more than one central bank. The government should have more than one banker. I don't agree with that, but because I think that then would lead to charges of political favoritism and so on, as it did do, by the way, when this sort of situation arose in the USA in the 19th century. At any rate, the kind of process of evolution I've described could be seen as a product of human action, not of human design, because none of the Goldsmith, when he started down this route, he couldn't see how it was going to end up. And all the different agents responding to different local stimuli and suggestions and opportunities, sometimes legislation was needed, but they arrived at this process, at this final outcome, by means of a spontaneous process. This is a spontaneous order, please, Professor Hayek. And then the answer comes back, no, central banks are set up to finance wars, as the Bank of England was in 1694, to finance King William's wars. Debate and discuss. Debate and discuss. It's all very controversial. Having said all that, what I've done today is to set out a reasoned argument that there is a rationale for the present monetary order as I've described it, and I therefore reject these radical critiques and proposals for radical change put forward by Hayek and Friedman and a range of other people in the free market economists in the late 20th century. Thank you.